This video will explain how to start investing in mutual funds step by step. Investing in mutual funds is one of the easiest ways for beginners to start building a wealth. You do not need a large amount of money or a deep knowledge of the stock market. Mutual funds allow many people to invest together and let the professional manage the investments. We will see simple step by step explanation of how to start investing in mutual funds. Now we will see in high level what are the steps you have to follow to start mutual fund investing. First, you have to understand what a mutual fund is. Second, you have to decide your investment goal. Third, you have to choose the right type of mutual fund. Fourth, you have to complete the KYC verification. Fifth, you have to select a SIP or lump sum investment. Sixth, you have to invest through a trusted platform. Seventh, you have to stay invested for the long term. These are the steps you have to follow. We will see in details. Mutual funds are popular because it provides professional management, diversification, and easy access to investing. Step 1. You have to understand what a mutual fund is. A mutual fund is an investment where money from many investors is pooled together and invested in different financial assets such as stocks, bonds, and government securities. Stocks is nothing but shares of companies. Bonds are nothing but loans to the companies or loans to the governments. A fund manager is a professional who decides where to invest this money. Now we will see the real life example. Imagine 50 people each invest 2000 rupees. The total becomes 1 lakh rupees. This money is then invested in different companies and financial assets. If those investments grow, all the investors benefit based on how much they invested. Step 2. You have to set your investment goal. Before investing, you should decide why you want to invest. Some common investment goals are saving for comfortable life after retirement, saving for children's education, saving to buy a house, building a long-term wealth. Your goal helps you to choose the right mutual fund and investment period. If someone wants money for a house in 10 years, they may choose a long-term growth mutual fund. Step 3. You have to choose the right type of mutual fund. There are different types of mutual funds. First one is equity mutual funds. These invest mainly in stocks and aim for higher long-term growth. Second one is debt mutual funds. These invest mainly in bonds and government securities, and these are usually less risky. Third one is hybrid mutual funds. These invest in both stocks and bonds. A young person who is investing for 20 years might choose an equity mutual fund because it has more growth potential. Step 4. Complete KYC verification. Before investing, you must complete KYC verification. KYC is nothing but know your customer. This is a simple process where you provide identity details like a PAN card, your permanent account number for identity verification, address proof, a document confirming your residential address, bank details, your bank account information for transactions. KYC helps to ensure that the financial transactions are safe and verified. Step 5. Choose an investment method. There are two common ways to invest. First one is lump sum investment. A lump sum investment means investing one large amount at once. For example, investing 50,000 rupees in mutual fund in one payment. Second one is SIP, which is nothing but systematic investment plan. A systematic investment plan means investing a fixed amount regularly, such as monthly. For example, investing 2000 rupees every month. Many beginners prefer SIP because it allows them to invest slowly and consistently. Step 6. You have to select a mutual fund platform. You can invest through mutual fund apps, investment websites, banks, and registered investment platforms. These platforms help you to select funds, track investments, and monitor the performance. Step 7. Start investing and track your investment. Once you select a fund and start investing, it is important to review your investment regularly, stay invested for long term, be patient and consistent. If someone invests 3000 rupees every month for 15 years, the money may grow significantly because of compounding, which means earning generating more earnings over the time.